this short video, we will discuss liquidity risk, how it is defined, and how a portfolio manager handles the risks of owning specific types of investments. Additionally, we will discuss the advantages and disadvantages of employing liquidity risk management. Managing portfolio risk beyond directional and non-directional risk attempts to eliminate the risks that are based on the liquidity of assets within a portfolio. Liquidity risk includes the ability of a portfolio manager to unwind a position and generate cash in a timely and efficient manner. Historically, there have been a number of events in the recent past that have created the need to analyze the liquidity and transparency of a portfolio. For example, in 2008, even the very liquid Eurodollar contracts, which allow traders to hedge LIBOR, were relatively illiquid due to the financial crisis and the inability of banks to lend to one another. Liquid products such as government bonds, large cap equities, and currencies have relatively tight bid-offer spreads, which allow investors to enter and exit a position without significant slippage. A bid-offer spread is the difference between what a market maker will purchase a financial instrument, which is called the bid, and where a market maker will sell a financial instrument, which is called the offer. These type of markets are relatively transparent, and finding liquid price action is relatively available. And finding liquid price action is readily available. Certain types of assets, such as real estate or loans, are less liquid and are more opaque than liquid markets. Transactions on these types of assets can be few and far between, and the bid-offer spread can be very wide. Non-liquid products are usually over-the-counter products, which are traded under the guidelines that are governed by the market participants themselves. For example, many financial instruments that are over-the-counter instruments are governed by ISDA, or known as ISDA, the International Swaps Dealer Association. The guidelines give some semblance to the market environment. Products can range from interest rate swaps, which allow companies to hedge against specific interest rate exposures, to exotic options that are used to make more sophisticated bets. Most over-the-counter products are traded by market makers, which are generally banks, investment banks, and large hedge funds. The market can exist through exchanges such as the Chicago Mercantile Exchange or the Intercontinental Exchange, or a broker market that can be online or over the phone. Each position within a portfolio has specific liquidity and costs associated with it to turn it into cash. For example, a 5-year natural gas swap will have a large bid-offer spread and be larger than shares of a liquid stock such as Microsoft. When evaluating these positions in a portfolio manager should create a risk profile in which reserves are calculated to accommodate these illiquid positions. Evaluating historical bid-offer spreads will allow a portfolio manager to create a market risk reserve in which capital is set aside when a position is entered and released when a position is liquidated. Managing liquidity risk is an important concept that should be reviewed. Managing liquidity risk is an important concept that should be reviewed, especially for opaque portfolios. A historical market risk reserve is a formula that evaluates bid-offer spreads of specific assets to generate a pool of capital that can be removed from profits and losses. An example of how this works is as follows. Let's assume a portfolio manager purchases an over-the-counter product that has a historical bid-offer spread that is wide. A portfolio manager can create a market reserve where a specific amount of capital is moved out of the portfolio to account for the lack of liquidity. The reserve is added back to the portfolio when the position is closed out. The concept is similar to creating a margin account for over-the-counter products. Instead of posting initial margin to a futures broker, a portfolio manager creates an artificial margin account which insulates a portfolio manager from large slippage created by opaque products. The advantage of managing liquidity risk is that it employs some analytics on products that create losses when the portfolio manager exits the position. The more volatile the market environment, the more difficult it can be to exit a liquid position. The disadvantage is that income needs to be set aside to incorporate this type of risk management tool.